Here's a summary of the UPS second quarter 2025 earnings call, focusing on key financial metrics, management statements, and outlook. Introduction and financial overview. The call opened with a focus on UPS's second quarter 2025 performance. Consolidated revenue for the quarter was $21.2 billion, with an operating profit of $1.9 billion, resulting in a consolidated operating margin of 8.8%. Diluted earnings per share, EPS, were $1.55. GAAP results included a net charge, primarily due to transformation strategy costs, partially offset by a divestiture gain and an income tax benefit. CEO Carol Tome's remarks, strategic progress and business climate. CEO Carol Tome highlighted the company's progress against strategic actions laid out in January, specifically focusing on accelerating Amazon volume glide down. This is largely proceeding as planned, involving network reconfiguration and building closures. Transitioning Ground Saver product, deliberate pricing actions were taken to manage volume, leading to a decline in this product's usage. Generating savings through efficiency reimagined. These initiatives are redesigning end-to-end processes to drive savings. Business climate insights. U.S. economy demonstrated resilience, but the U.S. small package market was negatively impacted by historically low consumer sentiment and soft manufacturing activity. Consumers are trading down and splurging on discretionary items. International trade. Trade policies, particularly tariffs, significantly impacted international trade lanes. The China to U.S. trade lane, UPS's most profitable, saw a 34.8% decline in average daily volume, ADV, for May and June due to increased tariffs and the elimination of the de minimis exception. Trade diversion. UPS is well positioned to handle trade shifts, with volume on China to rest of world trade lanes increasing by 22.4%, and capacity between India and Europe nearly doubled. Nearly 90% of cross-border transactions were processed digitally, leveraging brokerage capabilities. Nearshoring. UPS is bullish on the opportunity in Mexico, despite a slow regulatory process for the Estafeta acquisition. Supply chain solutions. Global freight forwarding was impacted by trade policies, but this was partially offset by solid growth in digital and healthcare subsidiaries. Key strategic updates. Amazon glide down. 74 buildings have been closed so far this year. While building closures were smooth, a lower than anticipated attrition rate for part-time hourly positions resulted in higher expenses. A voluntary separation program for full-time U.S. drivers has been announced, with good initial interest. More building and sort closures are planned for the second half of the year. Efficiency reimagined. These initiatives are accelerating, with a new global payment strategy centralizing payments under a digital-first approach. Ground Saver. Pricing actions led to a 23% year-over-year decline in Ground Saver volume. The insourcing of last-mile delivery from USPS for this product, while improving customer experience, pressured financial results due to higher-than-anticipated delivery expenses. Solutions are being worked on for the latter half of the year. Healthcare logistics. This remains a key growth driver, with a focus on becoming the #1 complex healthcare logistics provider. The planned acquisition of Andlauer Healthcare Group is expected to close before year-end, enhancing cold chain and pharmaceutical transportation capabilities. Outlook and risk factors. No forward-looking guidance. Due to significant uncertainties in trade policies and their unknown impact on customer demand and the overall economy, UPS is not providing revenue or earnings guidance. Key uncertainties. Uncertainty around impending tariffs, including the expiration of a China tariff agreement. Difficulty for small and medium-sized businesses, SMBs, to absorb rising costs due to tariffs. Customers' inability to forecast demand for the holiday selling season, resulting in delayed peak plan submissions. Uncertainty regarding the timing of ground saver solutions. The full impact of the driver voluntary separation program. Focus areas. UPS is concentrating on what's within its control. The Amazon volume glide down plan, network reconfiguration execution, and productivity drives. Financial strength. UPS reiterated its strong financial position and commitment to its dividend, backed by solid free cash flow and an investment-grade balance sheet. CFO Brian Dykes remarks. Financial details and cost management. CFO Brian Dykes provided further detail on the financial results and strategic initiatives. Segment performance. U.S. domestic. Total U.S. ADV declined by 7.3%, driven by the Amazon glide down and revenue quality efforts. Ground saver ADV declined by 23.3%, with its portion of total ground volume at a two-year low. Revenue per piece increased by 5.5%, attributed to base rates, customer/product mix, and fuel. Total expense was flat year-over-year, but cost per piece increased by 5.6% due to ground saver pressures and network reconfiguration timing. U.S. domestic operating profit was $982 million, with an operating margin of 7%. International. Total international ADV increased by 3.9%, with all regions growing. Export ADV increased by 6.1%, but the China to U.S. lane saw a 34.8% decline. International revenue was $4.5 billion, up 2.6%. Revenue per piece declined due to geography mix and lower demand-related surcharges. International operating profit was $682 million, down $142 million year-over-year, impacting the operating margin to 15.2%. Supply Chain Solutions, SCS revenue was $2.7 billion, down due to the divestiture of Coyote. Air and ocean forwarding revenue was down due to tariff-related demand softness and lower market rates. Healthcare logistics revenue grew by 5.7%, and UPS Digital grew 26.4%. SCS operating profit was $212 million, with an operating margin of 8%. Cost out and network reconfiguration. $3.5 billion cost reduction target. UPS remains on track to achieve its target for the year. Variable costs. Operational hours are pacing down with volume. Semi-variable costs. Nearly 9,500 operational positions have been reduced year-to-date. Fixed costs. 155 operations have been completed, including 74 building closures. More closures are expected in the second half. Ground saver costs. Higher than expected delivery expenses are partially offsetting cost reductions. Q3 margins. Q3 margins may face more pressure than initially anticipated due to continued low volume, potential SMB customer declines, higher ground saver costs, and lower attrition rates. International and SCS performance is expected to remain stable. Capital allocation. Capital expenditures are expected to be approximately $3.5 billion. Dividends are planned at around $5.5 billion, subject to board approval. Approximately $1 billion of share repurchases have been completed. The full-year tax rate is expected to be approximately 23.5%. Most important statements, CEO Carol Tome. We are not letting this trade policy volatility knock us off our strategic plan. At UPS, we are proactively taking action to put our company on a much stronger footing and position our company well for the future. She emphasized focusing on serving customers, growing in attractive market segments, and creating shareholder value. CEO Carol Tome. Regarding the lack of guidance, she stated, "There's so much uncertainty out there. We are building scenarios, and the range of the scenarios, well, it's wide enough to drive one of our 18-wheelers through. So we elected not to provide guidance." CFO Brian Dykes. We remain on track to achieve our 2025 expense reduction target of about $3.5 billion. Partially offsetting this reduction is the higher-than-expected ground saver delivery expense. He also noted that Q3 margins may face more pressure than we initially anticipated, even exceeding the usual seasonal trends from Q2 to Q3. Highlights: strong revenue per piece growth in the U.S. domestic segment. Gaining share in the addressable market, excluding Amazon and packages under £1. Growth in healthcare logistics and UPS Digital within SCS. Agility in adapting the international network to trade policy changes. Progress on strategic initiatives, including building closures and efficiency improvements. Commitment to shareholder returns and a stable dividend. Lowlights: significant decline in the profitable China to U.S. trade lane due to tariffs. Higher than anticipated delivery expenses for the ground saver product. Lower than expected attrition rates for part-time hourly positions related to building closures, impacting cost savings timing. Uncertainty in the macroeconomic environment, leading to the decision to withhold forward-looking guidance. Potential for Q3 margins to face further pressure. In summary, UPS is navigating a complex and volatile macro environment, primarily driven by trade policy changes. While the company is making substantial progress on its strategic pivot, including managing Amazon volume and driving efficiencies, these efforts are being partially offset by short-term cost pressures and external uncertainties, leading to a cautious outlook and a decision to refrain from providing specific earnings guidance. The focus remains on executing the strategic plan to improve long-term profitability and shareholder value.